All right. What is up? And welcome back to another exciting show of how to invest in commercial real estate. What is up?
What is going on? We got a good show today. I'm excited to tell people about what we got.
Yeah.
But before that,
typically don't love telling secrets, but today we're going to expose one of the biggest secrets for sure in commercial real estate.
The biggest secret.
The biggest secret. Okay. I love the enthusiasm. Okay. So this week is a busy week. This week, I think tomorrow, actually, so we're filming.
It's Thursday. Tomorrow's Friday.
Well, the day it's releasing, okay? I'm playing chess. You're playing checkers, my man.
I've not ever been accused of that.
Anyway, tomorrow we are closing on the latest deal in Henderson, Nevada, which is right outside of Las Vegas. It's considered the Las Vegas market. We've done deals before there with Criterion. I know Precision's got several deals in Vegas and has done stuff in Henderson. So we've loved it out there. We've had great returns, great experiences. We found another great sponsor that I think can really start funneling a lot of deals over. I know we toured at least half a dozen other sites of stuff that we're looking at funding later on.
In Las Vegas, you mean? Or
in Las Vegas
in
with
Nevada,
that
Las
developer.
Vegas area, yeah.
Yep. I know we have one in Carson City or Reno, I guess, which is a little bit further north. Yeah. But anyway, super excited about that deal that's closing this week. We think it's going to be a super fast flip. And then the other thing we did last week is we just finished a site tour in Jacksonville, Florida. I was kind of, it's not like I was questionable, but it's just, I didn't have the inherent excitement about that project.
Before you saw it.
Before I saw it. And then we went out there and so let's play the drone video, actually. We got the drone video. So put the drone video up right here and you can see this intersection. It's basically like this 6 or 7 lane road has 50,000 cars a day. And then the other road on the intersection has 50,000 cars a day. So this corner is 100,000 cars a day. It's right in front of a Sprouts grocery anchored center. It's right across the street from a Publix grocery anchored center.
Guys, I didn't go to Jacksonville. They sent me the videos and I was sold immediately. Yep. I'm going to invest in this deal. The location just looks great.
Yeah, we sent Joel a video of it. And as soon as he got the text, he was like, let's do it.
Yeah. So we're excited about that.
Slam dunk. This one's a slam dunk.
And again, new developer. So excited about that. We looked at some other opportunities down there. We kind of toured the submarket a little bit. I know that, what was it? Beach Boulevard, I think was the name of it. Yeah. I mean, I would buy almost anything on that road after having gone out there now. Just some of the biggest master planned communities I've ever seen, just driving for miles and miles and miles. And it's the same master planned community.
No, it's a good market. And guys, going back to Vegas, we're trying to work with this developer. We got the deal in Reno or Carson City. We got the deal in Carson City. We got the deal in Vegas. We're trying to give you guys opportunities to have a tax-deductible trip out to Vegas. You know, if you have property there, if you're an investor in properties in Vegas, then when you go out there, you can deduct that trip. You're going to take a look at your investment. You want to drive by the property. You want to make sure it looks good. And so who doesn't want tax-deductible trips to Las Vegas? Who doesn't want them?
Oh, no.
No hands, right? Everybody wants that. So we're trying to help you guys.
Yeah. And actually, that's not a bad segue into our subject today, right?
It is. It is a good segue.
Yeah, because what we're talking today is about taxes. Yeah. And I know everyone's thinking, Skip, right? They talked about taxes last week or 2 weeks ago, whatever.
No, but this is different. This is one of the biggest tax secrets, tax hacks of real estate investing that we know about.
Brian says it's the biggest, and I love it. Let's get to it. Real estate tax professional.
What's that mean?
I don't know if you had to add the tax part. It's just like you're a real estate professional.
You're a real estate professional. Yeah. On your taxes. I mean, nobody actually cares if you're a professional in real estate, but according to the IRS, once they consider you a real estate professional, that's when things really start to change for your tax return.
Yep. And so let's talk about why or how you would want to do that. First, the why. We mentioned it last week when we were talking about taxes. Once again, taxes are your biggest expense
in life.
In life total. And so if you can spend any time reducing the biggest bill you have, it's going to pay off for you. It's going to give you more money to invest. But today we're specifically talking about how do I become a real estate tax professional and why. And the why is this. If you're an investor, a passive investor, let's say you give us some money, you don't do anything, you don't look at real estate, you don't spend any time on real estate.
That sounds like a dream, honestly.
Yeah, and people do that, they give us their money, and then we give them the returns. The problem is they can't maximize the deductions. So let's say we have a property, and the property makes the investor $10,000 in a year, but there's $20,000 of losses that we could deliver to that investor.
It's bittersweet, right? You're not paying taxes on the $10,000 of distributions.
That's a win.
But at the same time, you're rolling over this loss, but paying taxes on this other income that you're earning or your spouse may be earning. So, yeah.
And so then we're what this show is about is how do we get, if you're in a high income tax bracket, let's say you make $500,000 a year. And I know that's not a lot of people, but it is a significant amount of the investor base that we have. So if you're making $500,000 a year, most likely your tax bill, federal tax bill, is 40%. Mm-hmm. Okay, and maybe state tax, maybe another 5-10%. Yeah. And so you could be close to half your salary in taxes. So let's go back to the example. If you had $10,000 of write-off that you can't use 1 year, but if we could get that to be used towards your personal income, then that would be $5,000 in your pocket. Right? And so that's an additional return on your invested capital. So now not only, let's say you give us $100,000 and your cash flow is $10,000 a year, now you're making 10% on your money, but we could increase that return by 50% if you were a real estate tax professional and you could apply those losses, those depreciation losses against your ordinary income. Okay? That's what today's show is about. How do you, here's the thing, is when you're a passive investor, you can only apply passive losses to passive income. And so if you have more passive losses than passive income, you just have to roll it forward. You can't use it into the future. But if you're a real estate tax professional, that allows you to use your passive losses, they now become active losses, and you use those active losses, and you can use them against any income you make, ordinary income included. And that's the secret of the show today.
Yeah, and I think that's the big ticket here. A lot of people who have problems paying taxes, it's not typically long-term capital gain taxes that they're trying to get out of, or depreciation recapture taxes that they're trying to get out of.
Lower percentage, right?
They're lower percentages, and they're already at an advantage, right? Like that's the advantage is long-term capital gains instead of ordinary income. So what we're focusing today is how to lower that ordinary income number as low as possible, because you've already got these losses. All of our investors have these losses. They just can't use them. And I guarantee it, them or their spouse has some sort of ordinary income on their tax return that they wish they could be using their losses to offset that income. I mean, it would be aggravating. It would be so aggravating knowing you have losses and not being able to use them.
So, but here I can hear it now. There's these high income earners. Maybe you're a surgeon, maybe you're a business owner or a lawyer or whatever, and you make $500,000 a year, and you say, "Well, my spouse, they're busy. My spouse is stay at home. They're handling all the other things that I don't handle while I'm making $500,000 a year. And so that isn't feasible for me, Joel. It's just not worth it, right? It's not worth the time."
Yeah.
Okay.
The conversation probably went, yeah, my wife has tons of time for that. And then, babe, what do you think I do all day? I'm busy.
And no question, spouses that stay at home, they work just as hard and do just as much. But there's a way to do this where they can still qualify as a real estate tax professional and still get their day job stuff done. But here's the thing, is real estate, if done right, could provide enough losses if you bought enough property to offset 100% of that $500,000 income. Well, what does that save you if you're paying 50% taxes? $250,000 a year.
So much money.
So where else is your spouse going to do part-time work and be able to save you or make $250,000 a year? I don't know of any place.
I love this. We didn't write this down. This is live, folks.
I'm live coming up with this shit.
Yeah.
So, guys, that's what we're talking about today. And so let's get into how does this work? How do we get a spouse qualified as a real estate tax professional? So then all real estate investing losses can offset the high taxed earned income that you pay taxes on.
Why can't anybody? What you're saying is when you file your return under occupation, you put real estate professional as opposed to whatever your occupation might have been before.
Yeah, and just to clarify, just in case somebody's starting at the end of the podcast instead of starting at the beginning, or just picking a random episode, or somebody's scrolling through and says, "I want to learn the biggest secret." The reason real estate produces losses is because of depreciation. We're allowed to write off this depreciation as long as we pay it back when we sell with depreciation recapture. So that's why you have all of these losses. It's not a secret. That's what people love about real estate. But at the same time, if you're not adding value into real estate, you're just passively investing in it, which I don't know what percentage it is, but I would bet there's just as much wealth in completely passive real estate ownership than there is active. Maybe more. There's probably more wealth.
real quick, before we get into how you qualify, what are some other losses besides depreciation? What are some other losses in real estate? Could it be because your rental income isn't as much as your expenses? Is that what we're talking about? Or?
I mean, it's typically depreciation and interest are your two big ones.
Yeah.
Assuming you've got a good piece of property that's not losing money. I mean,
Yeah,
it's
but
depreciation
okay,
and
but
interest.
to your point, Brian, let's say you invested, let's say you invested in a real estate deal and it didn't go well. You had major occupancy issues, and now you have a major, you didn't make any money, but you lost money, and you have the depreciation losses. So you have this compounding huge loss.
Yeah.
But if you're still a passive investor, that huge loss is going to sit out there while you pay 50% taxes on your ordinary earned income.
Yeah.
That's a problem. Okay, so we're going to help you try to solve that problem
and
today.
if you don't have that much income for that particular year, you can roll those losses over for when you do make a profit, right?
That's right. But we want to help you take advantage of those today.
Okay.
So we got excited. We're going to tell you the biggest secret. We're going to get there. Okay. We kind of tease, but the biggest secret is really at the end. So you got to stay dialed in. We got to stay dialed in here. The next one is what is a real estate professional? Let's define this according to the IRS. What is a real estate professional according to the IRS?
Yeah, all right. The IRS has specific rules, right?
Yep.
Brian's going to walk us through them one by one.
Hey, full disclaimer, we're not CPAs. We do not file taxes. We hire CPAs to do taxes like you should be doing.
All this should do is spur you to go and research this subject and to talk to your accountant. But it is doable. We're going to tell you how right now.
Okay, so first qualification is the more than 50% rule. So more than 50% of your time needs to be spent on real estate business activities.
Well, more than 50% of your services. I don't know if it specifically says time.
Yeah, it's services.
Services.
So if you have a day job, if you're, like I said, if you're a doctor or something, then this is not, you're not going to be able to qualify because you're going to spend, 70 hours a week at the hospital. You're not going to spend you're not going to be able to argue that you can spend more than 50% of your time. But this is where a spouse comes in. Maybe there's a stay-at-home dad, stay-at-home mom, and they don't have another job. Well, now 50% of the services is easy to get to because you're not really rendering services 40 hours a week to somebody besides your family. And
you may not render any services. Maybe
so
the only services.
So now any work you do on real estate, you qualify for the 50% rule. And so let's talk about what that could look like. You may have a rental houses. You have to manage those. You have to upkeep those. Maybe you're searching for new rental places or new properties. That's acquisition mode. Maybe you're a realtor and you spend time on brokerage or on realtor services. All of these things count towards these qualifications right here that we're going over. And so it's not too hard to figure out a way to get there. Back when I started real estate and I was basically just trying to educate myself and looking for property. Well, now I'm driving markets. I'm looking on the internet. So I'm spending hours a day, looking for deals.
And those are services that you're rendering.
Yeah,
right,
that still qualifies as I'm trying to buy and make money in real estate. This is my business, and I'm spending time on my business. It doesn't matter that I didn't buy as many as I wanted to buy. It still is time, and it still qualifies under the 50% rule. So that's number one. Over half of the services you provide need to be in real estate.
Okay, number two is the 750-hour requirement. So not only does 50% of your time have to be towards activities, but it has to be a minimum of 750 hours in a tax year.
So there's 2,080 workable hours in a tax year if you're working a 40-hour week. So what is that? 750 divided by 2,080.
Well, what I'll say is
like a third.
Yeah, 750. I'll divide it by 2,000 because really, and that's 37%. Because most time you get weeks off for vacation and things. So if you just take a standard 2,000-hour work year, 750 is less than half of your time. Okay, and so then let's talk about that. I think that most people could get there if you take 750 divided by 52 weeks. 14 hours a week you got to spend.
That's 2 hours a night. That's a morning.
Yeah, it's an average of 2 hours a night, or that's like, could that be 5 hours a day on 3 days? So Saturday morning you get up and you go from 8 to 1 on a Saturday, spending time looking at deals, driving markets, analyzing stuff.
How many people go pick up the rent check, go deposit it, go drive by the property, go
meet with a broker, talk about a market.
Boom, 2 hours. You do like, it's not that much time.
So what we're saying is you can get there. A spouse can get there. And you're like, well, I don't, maybe they don't want to do 2 hours a day, or 3 hours a day. Fine. But there's going to be certain circumstances where that 2 or 3 hours a day can end up saving you or generating hundreds of thousands of dollars in income by eliminating a tax bill. So that's why it's really, really worth it, depending on your circumstance, to evaluate how to get this done for you.
Okay.
Next.
Okay. So the next thing the IRS does is they stipulate what these activities are. And I'm not going to comment about each one of them. I'm going to read them out, and you guys tell me if you want to make some comments afterwards. But some of the services that qualify are rental unit management, new construction, property and business operations, time spent as real estate or broker. Realtor or broker, right. Property development or redevelopment, and property acquisition.
Yeah, so literally everyone is a realtor. I'm a realtor. I've got a real estate license. I never use it because we're principals in the transactions, but literally everyone knows like 7 real estate agents. Nobody has a problem finding a realtor to sell their house. All of those people are real estate professionals. I mean, okay, there's several tax requirements, or there's several requirements that I may not know intimately. I'm just saying, like 9.9 times out of 10, a realtor is a tax professional and meets these requirements. Would you guys agree with that? Not 9 out of 10 times?
My guess is that yes. If you're a realtor, even if you're not selling a bunch of houses, if you're trying to get listings, if you're kind of working in the business, you're pitching your realtor services to your friends and family.
Yeah,
that could all add up to becoming a real estate professional.
And we were kind of chatting about it in the beginning because you're supposed to kind of keep records of this time, and it kind of seems a little bit insane. But my point was just my calendar. At any point, you can pull up my calendar, and I've got well over 750 hours booked in my calendar with a name, an address, a time, a place, a Zoom, or whatever it was, with a quick note about who I met with. That would easily justify a real estate or a real estate professional designation. And I'm sure a lot of people are doing something similar already. It may just be their email. Like if you went through my email, you could see that I'm spending, an hour or two a day, or hours, or responding, reviewing material all day. It would be easy to justify in a sense.
That's a good point. When I think about some of the tips we've told people about how to get into commercial real estate is to get on brokers lists, to get properties emailed to you. I get hundreds of emails a day looking at property all around the country. Now, do I look at all of those? How long do I look at them? That's up for you to decide if you're going to try to meet this requirement. But if your inbox is flooded with deals and you're having email correspondence with let's say a broker in Dallas about an apartment complex or a potential retail deal you're going to buy, all you're doing is you're documenting the hours, and the IRS comes in and they say, okay, did you really do stuff? Were you really working on real estate? You're like, well, look at my inbox, dude. I have 500, 1,000, 2,000 emails with brokers all around the country. And you can see here, I drove and was looking at these properties. Mm-hmm. Another thing, think about let's say you had a good opportunity. You heard about an investment in, let's say, another city like LA or something, and you wanted to go out there for the weekend and meet with brokers, get to know the market, drive the market, and maybe even put an offer in on a small retail deal in LA. Well, if you did that over the weekend and you left on a Saturday morning and you came back on a Sunday night, I mean, that you might could book 30 hours, right? Because I don't know, but I think all of that time, if you were working for a company, you would bill a lot of that time, and maybe not while you're sleeping, but for sure the daytime that you're getting there, all that's billable time. If you're in the industry. So
we're running out of time, and I want to get to a point here. I think, in short, we can kind of justify this as 750 hours. Figure out a way to actively involve yourself to 750 hours. What would be a dollar amount that would be worth it? I mean, $1 saved is $1 earned. So if you're not paying $1 in taxes, you earned that dollar by being this real estate professional, regardless of whether you're bringing in income or not being a realtor. Like you could not sell a single house in a year and I think still work 750 hours. So let's just say it was $100 an hour, where you felt like you could do your 750 hours a year if you could just make it worth $100 an hour. That's $75,000 a year. I bet there's a lot of people out there. That are investing with us that if their spouse got a real estate professional designation, they could save up to $75,000 a year.
And what people need to remember is this is $75,000 net, right? This is not $75,000 job where you're going to pay taxes on top of that.
No, this is straight up net.
This is directly $75,000 in your bank account.
All right, so we think you can get there. If you have questions about how to get there, text us, call us, and email us. We'll help you get there. We've done this, but let's keep going.
Okay, the next thing the IRS stipulates is this has to be a single taxpayer requirement. In other words, the three of us can't try to qualify for this, for instance, the 750 hour requirement. Collectively.
It's not associated to a business, nothing.
Yeah. So each taxpayer has to qualify for all these stipulations.
But the great thing is they make an exception for married couples filing jointly.
Yep.
Right?
Guys, this is the biggest secret.
That's the secret, okay? Is that in any other circumstance, you have to spend the time. But as a married filing jointly, only one partner needs to. But if one partner qualifies, then all the losses or depreciation or anything can be applied to either of their earned income. That's the secret.
So let's take somebody making $500,000 a year because it's an easy number, not because it's an easy salary to obtain, but because, I mean, a $250,000 salary, whatever number you want to do. What do we think the average tax bracket is for that? 30%, 40%? So, I mean, what is this?
Well, $500,000, I think you're up to the 35 to 40% federal.
Let's do 250,000 times, what is that? 0.3, 30%?
Well, no, 250 would be probably 30, 35 maybe.
And it's graduating, so it's not exactly 35.
Okay, so 87,500 is what you would pay in taxes. Okay, so I mean, I think that's worth it. If you're making, let's just say a 6-figure salary. I like if you have 6 figures of ordinary income coming in and you have access to real estate losses, which you should be able to do with 6 figures, you should seriously look at becoming a tax professional. It would be
real estate professional.
Real estate. I keep
it's
doing
okay.
it
It's
every
all right.
time. We're at the end of the show, and I still
that's all right. Joel said it a bunch, and he doesn't even realize it.
Yeah.
Oh, that's even better.
I'm sure I have.
Just wait till you watch the.
Oh no, Aaron's going to delete all that.
He's going to delete
Joel
the word
never
tax.
said it.
He's going to delete the word tax.
All right. What else we got? Because I think we're almost to the end.
Okay, so the IRS is going to tell you that they require documentation that you've worked. We kind of touched on this a little bit, but they're going to say that they require documentation. So, what kind of documentation?
Don't freak out about the documentation, guys. Let's say that the documentation is that you put down in your calendar that you were working on, acquisitions, and you were looking at deals from 6 p.m. to 9 p.m. and maybe you copy some links into the documentation of some properties you looked at. I mean, the IRS, what can they do? They can't say, well, no, you didn't. No, you didn't spend 3 hours. They're just trying to make sure that they're not getting scammed. So don't make it overburdensome here. They just want to know, are you in the game or are you not in the game? Are you doing the work? Are you involved in real estate or are you not? That's all the documentation is. It's just to make sure that someone's not just claiming that they're a real estate professional and they don't even bother to look at real estate. Okay. So I would advise you to look up what documentation you might need, but don't let it be a roadblock to you pursuing this because it's worth it.
Yep. I agree.
I think the last point, just to clarify, being a real estate professional,
good job.
There you go,
does not get you write-offs. Just to clarify, investing in real estate gets you write-offs.
Right.
So this is really only applicable to people who invest in real estate. We should have said that at the beginning, maybe.
Yeah.
If you're investing in real estate,
right?
Then this is the biggest secret.
Yeah.
Well, I'm just now realizing that maybe some people are like, well, this doesn't save me any money at all. I can work 750 hours and I don't save any money on taxes.
So there's only 2 ways to save money on taxes is to have expenses where you actually spent money. Like maybe you went and looked at a property, your
Bought a new
car
truck.
mileage, your phone, all those deductible expenses that we talked about last week. But the other thing is to have the depreciable losses that come from owning real estate. So if you have neither of those, if you're not spending any money trying to buy real estate and you don't have any depreciable losses owning real estate, well then this isn't for you.
Yeah.
But if you want to be in the game and you're already looking to buy real estate, this is going to be important. Okay, is there anything else?
Nope, that's it.
That's all she wrote.
Well, guys, biggest tax secret in real estate is having one of 2 people filing jointly to be able to call themselves a real estate professional.
Also, just realized something else. This is not for single people.
No, I just decided I'm getting married. I'm getting married. This is such a big deal. I'm getting married.
Look at you.
He's already a tax professional.
Wow, that was fast.
He's already a real estate professional. See, I did it already.
Oh yeah, that's true.
Tax
Well, I guess I'm not then.
All right, that is it. We will see you guys next week on how to invest in commercial real estate.
Thanks, guys.